All right. Thanks everybody for joining us today. This is being recorded and this is part two of a four-part series on earnings. So we did the calls, we're going to do the puts, then we'll do the strangles and straddles, and finally we'll finish up with how to manage one of these if they go against us. And you know, it's actually a good exercise for any time a strategy goes against us. So it is usable in everyday situations as well. So keep your eyes out for that one. That's a really good one on managing your risk. But like I said, this is going to be on earnings trades. And let me go over a couple of things real quick to get this out of the way. My name's Eric Wilkinson. For some of you who may recognize me as the Wolfman from CNBC, Fox Business, Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I basically graduated from Chicago and moved up to the Board of Trade and started chatting with Rick. We always used to have little debates, and that's how I kind of got on CNBC and able to do some of the things I was able to do. But in that time, like I mentioned, I started trading in college with some money I earned. I started buying stocks and then got into covered call strategies. That's how I got into the options. So then that led over to basically moving into the 30-day Fed funds pit and trading those futures there. But in that time, I've traded, in the last 25 years, traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. Aside from the crash of '88, I basically, or was it '87? I don't even remember now. I think it was '87. I started trading shortly thereafter. Anyway, this basically says any opinions, news, research, and analysis or other information contained here or material provided by ProTrader Strategies and associate companies is to be considered general commentary and does not constitute investment advice or solicitation to buy or sell any of these securities or strategies. At the end of the day, what this is basically saying, I can't give you investment advice. I can't even show you my portfolio or give you guys real statistical results because the SEC does not allow us to do that, does not allow me personally to do that because it would be considered investment advice and we're not allowed to do that. So if anybody's out there doing it, they're really breaking the rules and the SEC could really come down on them. And I don't want that to happen to me. So, you know, take what we teach you in these webinars and implement it into your portfolios with your own risk parameters and your own portfolio in mind, because what I'm doing could be counterintuitive. And remember, bottom line is do your own homework. Please remember that past performance of any trading system or methodology is not necessarily indicative of future results. Also, you can follow me on Twitter at Wolfman's blog. You can follow ProTrader Strategies at ProTraderStrat. Especially during your earnings seasons, I will tweet out what earnings trades I do, because in the daily market commentaries that I do every day, I tell you exactly every single trade I put on, when I take them off, how I manage that risk, and whether they're winners or losers. So I suppose you guys could keep track of me. But in that, and you'll find out with earnings, I like to put these trades on at the end of the day to get a nice bar basically and be able to split it, you know, on the up and down, because a lot of times, if you guys watched the last webinar on calls, you know, Tesla one earnings season basically rallied like $10 or $15 in the last couple hours of the day, and if you had put that strategy on for earnings earlier on, that would have really kind of skewed you to one side or the other. Your puts would have been already almost worthless, but your calls would have almost been in the money. So put it on at the end of the day. You have a clean line in the sand so that you can get above and below the market maker move in a sense. You missed the first one on calls. Is it possible for you to email that to us? Ambreen, why don't you, if you at the end here, you can write down the email address and email them, because I'm not going to be able to, I don't have access to all your emails and all that stuff, but somebody can reach out to you on that if you send an email to trading@protraderstrategies.com. Okay, like I said, this is earnings trade setups. And in earnings, the best thing about this is we have implied volatility that's pretty high. And I like to sell strategies around high implied volatility or volatile markets, because when it reverts back to the mean or reverts back to normal, you get a volatility contraction, and that's where you can make a lot of money rather quickly. The best thing about earnings is you know exactly when that is going to come out of the market. It's the day after those earnings are released. So the volatility builds up in anticipation of that binary event, and as soon as that binary event's over, volatility falls out, and that's where you make your money. You can do this kind of around any type of binary event. Fed fund futures and options, we used to do it around the FOMCs, because the volatility would get pumped in there, and we knew as soon as the meeting was done that the volatility was going to crush, and usually played the probabilities on what type of move they were going to do too. So that was quite nice as well. Anyway, some of the rules are, we have to have high volume and open interest in the underlying we're trading. You don't want to do this in something, let's say AutoZone, where everybody's heard of AutoZone, but there's just not any people in there trading. Another thing is high implied volatility. We're seeing more high implied volatility this earnings season than we did last earnings season. Last earnings season was horrible for me in a sense, although you're going to get that volatility crush. It's just that you had to be so close to the market because there wasn't a lot of volatility in there. When there's a lot of volatility in there, you can get a lot further away from where the market is to put those trades on. And volatility, having generally overstating what is going to happen, that's how we can take advantage of it. So if there's not a lot of high implied volatility, you start getting pretty close to the market, and there's a possibility that it could go, there's a higher probability that it could go outside of that market maker move if there's no volatility. And enter the trade at the end of the day. I mentioned that. That's one of the main things to do. Don't put these on early in the morning, because you have 5-6 hours of trading going on, and that could move quite a bit. It could, a stock can move $1 in a day or $2 in a day. Some of the bigger stocks will move a lot more than that. But if that were to happen, you're going to have one of your options closer to at the money, and it's not going to be within the statistical one standard deviation move anymore, which is what we're going to be looking at. Is 19% volatility related to one standard deviation? Volatility isn't really related to the standard deviation. What the standard deviation bell curve, and I'll go into that in a minute, is it will get skewed. The volatility curve gets skewed a little bit, and when the volatility is high, it flattens out a little bit as well. So if you can imagine, when you squish down a bell curve, those lines go further out. That's what we're looking for. That's what volatility does to the bell curve, is it squishes it. So you can think of it as a weight. Like the bigger that volatility is, the more it squishes down the bell curve, if you want to get a mental picture of something. Luke, I'm going to tell you how to figure out the one standard deviation in a minute. End of the day being what time? 3 o'clock or later on East Coast time. Yes, that's usually what I do. Basically, after 1, 2 o'clock, I really start looking at it, and then I try to put it on in that last hour for the most part, even to the last 15, 20 minutes of the day, which is how if you're around a little bit earlier, that's why I missed the Visa one, is because I was actually got onto a phone call and was got sidetracked, and the next thing I know, I'm still in this phone call, and I heard my bell go off on my computer, and that meant that was the end of the day, and I missed it. But Yeah, so I try to do it towards the end of the day. Are these before earnings or after earnings? Always the day before earnings. So I've got a couple of things that I'll show you, but I put it on in the last hour, the day before, or the day of. If it's after the market, I'm putting it on that day. If it's before the market, the next day, I'm putting it on just the day before. So the last hour, the final hour, if you will, so you can get a clean number. Okay, I think how is volatility related to one standard deviation or two standard deviation? We'll talk about that, or I think I pretty much explained that, but I'll show you some other things to look at also on the option montage as well. So anyway, we're going to take advantage of volatility collapse because we know when we have an earnings that there is volatility collapse. As a matter of fact, and it always leads up to it. Here's a chart of target, and you can see this is what I'm talking about. This is implied volatility. It ramps up basically going into earnings, and then boom, you know it's happening. Boom, afterwards. This one started breaking before a little bit, but on that day it broke. So here we are after earnings. Volatility starts increasing into the binary event. So I wouldn't expect volatility to come off very much in target from now until their earnings. Later, 5:15 is their earnings date. All right, so moving on, and that's the volatility. We used to call it the crush, volatility crush on the floor. And then theta contraction. What happens with volatility is when volatility pumps up, it synthetically holds off theta decay, really. We still have theta decay happening, but it really kind of staffs it off a little bit. And then when you get that crush, all the volatility comes out of it, all of the theta comes out of it all at one time, and that's when all the premiums come out. And I think this chart got out of order. Sorry about that, but we're trying to take care of take advantage of the theta contraction. As you can see, usually when I'm talking about strategies, we're putting them on somewhere out here 45 to 35 days, so we get this 50% volatility or theta contraction. This we're going to be playing way in here, and what happens with volatility, like I mentioned, it holds off this theta decay because you would think that theta is really contracting quite a lot here and you wouldn't have any premiums. What happens is volatility acts like a balloon in a sense and pushes this upwards a little bit. So when volatility comes out, it's like you let go of the balloon and volatility comes out, theta comes out all at once. So volatility is pumping up the balloon and holding in the theta in a sense, if you want another visual. All right, so this particular earnings trade is going to be on naked puts and selling put spread. So that's bullish. Anytime we're selling puts or selling a put spread, that is bullish. You have a neutral to bullish assumption in a sense. So if you're in an IRA and trading that, then I would go with the put spread. I like to do the naked puts and the naked calls and the naked strangles. And when I say naked, that just means you are short that particular strike. There's not defined risk. And the reason why is because you can get further out on the option montage in order to collect the same premium. So I look at it like there's less risk in selling a naked put than selling a put spread, despite the fact that a put spread is defined risk. You know what you're getting into. You just kind of have to get a little closer to the market to get any premium, which kind of puts you inside of that one standard deviation move in a sense. Okay, a couple of questions coming in here. How do I calculate the one standard deviation move? I think I've read that one already. We'll do that in just a second. Are there before earnings or after earnings? Did that, thanks. Got confused about what you said, before earnings announcement or after. Just before the earnings announcement. So if the earnings come out after the close, then we're going to be putting it on in the last hour. If the earnings for that stock comes out in the morning, we're putting it on in the afternoon. If it's a day or two later, I'm going to wait for it. The reason why is I want to get that clean number. I want to make sure that my puts are far enough away, in a sense, that I have a clean number. If I put it on early in the day or a couple of days beforehand, we could see the market come down to my puts relatively soon before the earnings announcement. And then you have a lot higher risk on, because now you're really close to the market and you got to be really directionally right in order to be correct, or to make money. Excuse me, I think I'm going to sneeze. Fake out. I got ready to. A minute sneaks up on me, sorry. Sorry about that, guys. All right. So, like I mentioned, bullish to market, neutral on this. On the bull put strategy, we're always going to collect a premium. So that's the way I trade these. I don't go in and buy calls. And the reason why calls or puts on a earnings, because I'm buying that high volatility then, and I really have to be directionally right. So, and with all the volatility coming out of it, you know, you have to make up for that loss in volatility by the underlying outpacing that, and that can be very difficult because, like I mentioned, volatility has a tendency to overstate and get it's a fear indicator, in a sense, of the way people feel around the markets, and fear is generally, because it's an emotion, is overstating. So just keep that in mind. So we're always going to try and collect a premium. And this is a little hack for you guys, especially if you don't use like TD Ameritrade. I don't know about some of the other ones, but TD Ameritrade will give you the market maker move, I would say 90% of the time, because I've seen it where it doesn't give you the market maker move for a binary event, and sometimes it's even days in advance it won't give it to you. But if it is not given to you, the way to figure it out, and it's a ballpark figure, just like theirs is a ballpark figure on market maker move, and there's other ways to come up with the market maker move where you basically take the trade price, multiply it by the implied volatility, divided by the square root of the days in the year. It's just a little crazy. So on the floor, that was almost impossible to kind of do, because you'd have to pull out a calculator and try and do 3 separate computations by multiplying the price times the IV, and then go and figure out what the square root of the number of days, divide those two sums together. That's just a lot of work. This is much easier, and sometimes you can even do it in your head, but it's the at the money straddle times 0.85. That will give you basically within a couple of pennies what the market maker move, and because it's all a guesstimation in a sense, it ends up working out. For instance, this was JP Morgan last week, I think it was. I took a screenshot of it. So here's the market maker move right here. You can see this, it's MMM, and it says it's $1.73. JP Morgan's earnings were coming out after the close on this day, and volatility, as you can see, is really high at 40. This isn't the IV percent. The IV percent for JP Morgan was probably somewhere in the 80s. So that's a little bit different. And this is also a market maker move. There's only one day to go, and this market maker move is saying it's $2.21. Just like, you know, this is what the expected move is to the end of expiration. This is saying $2. This is saying $1.73, right? Just like, you know, another option saying 9 days ago in April, it's saying that it could move $3 or very close to it, $2.90. But my thing is when you're in a pinch and this isn't given to you, and I almost never look at this because I always think that that's a little off. But anyway, so we take the straddle, the 85 straddle. You could go to the 85.5 straddle, but let's just do the 85 straddle for math purposes, really. But basically, we take we take a 77 cents plus $1.23. That gives us $2 times 0.85, and that gives you $1.70. So mine says it's $1.70. So it's going to be somewhere in and around that. Yeah, you take the out the money premiums, and of the calls and the puts, which is what a straddle is, you know, basically a call and a put, either selling both of them or buying both of them. But in a sense, you just kind of add those two together and multiply it by 0.85. You could have done it with the 85.5. It might give you a slightly different number, but you know, I did it for math purposes because $2 times 0.85 is easy to do in your head, right? So that gives you around $1.70, which is right in line with this. So if they don't give you this, or your platform doesn't give you what the estimated market maker move is, that is a real easy way to do it. Also, you know, you could have gone with the $2 move. Usually, to be honest, if I come up with $1.70, I'm looking at $2 anyway. I'm just rounding it all the way up, always rounding up to, in a sense, get me further away from the market, right? So that's how to figure out the market maker move on your own. All right, so essentials to success, picking the right strike. Now, you guys, we talked a lot about this already. Picking the one standard deviation move is picking the right strike. So what is the one standard deviation move? Well, this is the one standard deviation move. And if you add up all of these, it comes out to right around 16, right? So it's just slightly shy of that, but at the end of the day, it's 16. And one neat little thing about the bell curve is one standard deviation move is equivalent to a 16 delta. So that's a little trader hack for you. The delta can tell you what the standard deviation move is. So we're going to be looking at anything outside of a 16 delta for anything that's a naked strategy. On the put spreads, we're going to have to go a little bit closer, and I'll show you where that is to come up with the right ratio on your risk reward. But you are going to have to probably go a little bit tighter. Otherwise, if I sold a 16 delta and bought like a 10 delta, you're just not going to get very much premium. But if you wanted to synthetically make your strategy look like it's naked, you're not going to be decreasing your risk. What you can do is sell that 16 delta-ish option and then buy one way out here in the 3 standard deviation move area or further, where you can buy it for a couple of pennies. And that just gets you around the rules of an IRA saying you have to have defined risk strategies on. But keep in mind, it will not decrease your risk really, because the likelihood of it going out there and trading to your short strategy, or your defined risk part of the strategy, the long put, is, you know, basically less than 0.1% of the time. So 99.9% of the time, it is not going to help you out. So this is also another bell curve, and you can, the nice thing about this one is it gives you the half standard deviation move. That's probably where we're going to have to be on the put spreads. So if we add up all of these, basically we're looking at about a 31-ish delta, 30-ish delta to get that spread width that I'm going to be talking about here, to make it worth your time in a sense. What is the move of the stock for a one standard deviation move up or down? Say the stock is at 80. It all depends on the volatility, John. So a one standard deviation move on a stock that is trading 80, just look at the option montage and find the 16 delta, and that's the one standard deviation move. That makes sense? Does everybody get that? Because that's a good question. It's all dependent on volatility, the 16 delta. So let me see if I can go back to that. So right here, so if we look at this option montage right here, here's the 16 delta for JP Morgan. That is where the market's predicting a one standard deviation move is. So in a sense, we were looking at this $1.70 move, or $2 move is what I rounded up. So $87.50 is kind of where the market's predicting this move. That's why I'm liking that 18 delta. It's because it puts you outside of that market maker move when you're just selling it naked. Now, if we were going to be doing this as a strategy, put spread, I'd probably have to sell this 34 delta, which is right around that 30 delta that I was talking about, and then you end up buying this 28 delta, and that give you somewhere right around you're looking at a quarter to 30% the width of the strikes. That's your collection. So if it's $1 wide, you'd want to at least collect somewhere between 25 and 30 cents for the width of it. But keep in mind, then you're a lot closer than you would really like. I would really like to be, especially on a $2 move, because that $2 move kind of puts me where my long strategy is, where the market's predicting it's going to go. So keep that in mind. You know, if you have a real directional assumption, then that's different. And I'm sorry, I am looking at the calls. We are talking about the puts, so it would be kind of a pick 'em between the 3.5s and the 3s. I'd probably pick the 3.5s on this one and go a little bit higher. Oh wait, no, the 3s. Sorry, the 3s are a 16 delta. Let me get sense of everybody. So the standard deviation one standard deviation strike, yes, depends on volatility, absolutely. So if the volatility for JP Morgan was even higher than this, or I don't have a snapshot of the implied volatility percent, but if it was even higher than this, say it was 50 or 60, your 16 delta would probably be out here at 82. And this would be a 16 delta then. That makes sense? All right, picking the right duration. I already kind of mentioned that with the bell curve. That's why I talked about that, or that one slide being out of order. That's the theta contraction. We want to pick the right duration. We want to get as close to expiration as we can. So if there is weeklies that have good volume and open interest in it, then that's the one we're going to pick. So, you know, JP Morgan has good volume and open interest, and most of them will in the weeklies right around earnings. Like you can see, this is a great market. You know, it's 1 cent wide. And one thing I generally mention about picking the right strikes and the right underlying, anytime you have a stock that's under $100, you guys, make sure this bid offer is inside of 10 cents, being tighter than 10 cents. That means there's a lot of people in that underlying trading it for the earnings, or in general, even if there isn't an earnings, stay away from the ones where, you know, the bid offer is 25 cents wide, because if you have to go down to sell, you know, if it's 50 cents bid at 75 cents, and you have to go down there and sell it all the way down to like 60 before you get filled. Well, think about it. You could go on this for days and days and days, and now it looks like you're doing pretty good because it's 25 cents at 50 cents, but you have to give up so much edge to get out of it again. And it's just not worth it. You're eating up all of your yield, and you're taking on way too much risk if you have to give up that much edge to get in and out. So anything under $100, 10 cents wide, anything over $100, just move the decimal, you know, what is it, 3 ticks to the left, and that's how wide the bid ask should be. So if it's a $300 stock, it would be about 30 cents to the bid ask. And, you know, the $1,000 stocks, you know, they could be like $1.50 wide if it was a $1,500 stock. All right, so keep that in mind. Stay with the tight ones. All right. Oh, I do have the slide in the right place. It's just out of order also. I have an extra one. All right, so picking the right environment, high implied volatility. All right, definitely need high implied volatility and very close to expiration. Picking the right underlying, I just kind of went over this with that option montage. Tight bid ask, that's what I'm talking about with this. 10 cents wide on any stock under $100, or move it 3 ticks to the left and figure out how many pennies it should be wide. And know your exit strategy. Get out of this thing the day after, you guys. As soon as that binary event gets done, I mean, I even sometimes put these orders in when I can see it's going to be pretty much inside the market maker move. Get out right afterwards. That's not just, that's only on the winners. Don't let the winner turn into a loser in that regard. If it's already a loser and it's in your face like it was for me at IBM, I go to defensive mode and ways to manage that risk. So if you saw me on mine, I was rolling down calls. I'm going to actually let IBM get put to me and start doing covered calls on it. So, but that's only if it's against you. And I'm going to do a full-on webinar on if these go against you. But the day after, get out as fast as you can. Even if you got to get, don't squeeze it out for a couple pennies to go into expiration. I mean, you've already made probably 80% or 90% in some regards your money, and then you're going to risk it all by riding it out. I don't do that. I would rather give up the 8-10 cents and keep the money I already got. All right. So your max profit, anytime with selling strategies, especially around earnings, it's the credit you received when entering the position, or it's the with the put spread, it's the short put, and subtract that by the long put strike. All right, that is going to be, I don't know, the short put credit and the debit. Yeah, so basically the credit, you're going to receive more of a credit. So, you know, in that one, if I sold one at 60 cents and subtract that by the put that I bought at 30 cents, then 30 cents is the max profit. Max loss in that same situation on a $1 wide strategy, so is going to be the difference between the strike prices minus that credit received. So in that one example, I gave $1 wide for JP Morgan in a sense. It's going to be basically, if we look at the montage, you know, if I sold these 73s minus the 39s, so that would give me a credit of, what is that, 34 cents or something. I'd probably even look at these, the 54s to the 27s, and try and get it closer to 25 cents so I can get further away. But then if I was doing $1 wide here, between the 86 and a halves and 87 and a halves, collected 25 cents, that would be my max profit. My max loss would be 75 cents. Does that make sense? All right, and then I don't have, somehow I lost, I got all of these things jumbled up somehow. So, and then the break even is going to be the short strike, short strike. So if we sold the short strike minus the credit received, so if we sold the 80, but let's give a real example, the 83s, when this underlying is trading at 82.79, that would be about where our break even is, depending if we've got 21s or 22s, right? So that's our break even to the downside. What's the significance of an 80 delta preference in option strategies? Well, an 80 delta, are you talking about the 80 strike? An 80 delta would be in the money. So, you know, you'd be looking at something like this. And in that, if you were going to sell these puts, I mean, you got to really be directionally right. You got to have it move, at least the market maker move. I don't like to do that because if it goes the other way, these are going to increase in value 73 cents for every dollar it moves down. That makes sense? I think so. All right, so this is, again, the same one. It's JP Morgan. I cut it off because sometimes when I put it on here, the numbers aren't big enough to see. So can everybody pretty much see it? See all these numbers and everything? This is the day before. We've got the high volatility right here. We've got this volatility in the next month. So that's how you can also tell when the earnings are. Like if you're curious as to, when targets earnings are coming up, you can just look at these, and whichever one is the biggest, wherever it like jacks up the most, that's where the underlying has earnings, and that's the earnings that is going to expire around those binary events. But so that means that this one would be the best one to trade. In that, we've already figured out how to come up with a market maker move. It's about $1.70. Now, one thing to note is if this is the highest one, this is right after the event, there's an assumption here that we could see this 41% break down to 26% right after the event. And that's just on the low end. It can go even further, and generally does, but it's a good way to come up with an assumption of how much volatility is going to come out of it. And this is, if we do the math on it, we pull up a calculator, we could probably figure out that that's about a 28% drop from 41 to 26. So if we figure that is the 28% drop before even the event happens, and this is the nice thing, one of the nice features with Thinkorswim. So if you're using Thinkorswim, you can do this. You can go up here and hit right where you usually see this single spread delta gamma area. You can click on theoretical value. And if you click on theoretical value in that, it'll give you this other little pop-up here, which is neat. You can drop it down and punch around these numbers. Now I did a screenshot here, and every time I did the screenshot it wanted to shrink back up, but you can go in and change these different values. So I gave the assumption that the following day, because I did this on the 12th, I changed the date to the 13th. The following day volatility would crush by 28%, meaning from 41.80 to 26.60. Getting my percentage there, and this is a percent of a percent, which is a little misleading. You can look at it and think, oh, I think the volatility is going to go down to 28. Well, no, it's actually the volatility is going to decrease by that percentage point. So just make sure you make a note of that. It's not really going down to 28, it's decreasing by 28%. And I said that the stock price would move up by $1.80 in the theoretical value. So that would mean that if it goes up by $1.80, this would be trading 86.90 or close to 87, right? It's 32 cents. So that would be if the market moved to the market maker expectation, it would go from 32 cents to about 15 cents. So keep that in mind. The market has moved right to your short strike, and you could be almost in the money basically, and it's broken down to 15 cents. So you still made money. You were directionally wrong, or if we look at the puts, I had it move up. I always default to the calls, I'm sorry, but the same thing could be done here as subtracting $1.80 for your put strategy. If we were looking at this as a $2 move, you'd see that these were basically worth zero afterwards. We were directionally right, got the volatility crush, and there maybe a penny. But if you were to do the calls, like from the call webinar, I didn't have these screens, so you can kind of relate it back to that too if you're a part of that. But if we had sold the 87s, which if we go back here to this one, the 87s are just right around that 16 delta. We probably would have sold the 87.5s. But if I had sold the 87s and the market came up and basically kissed my short strike, I would have sold them for 39-ish and been able to buy them back, being directionally wrong, for 15 cents. And the same thing goes on the put side. I just put a positive there. If I would have put a negative there, we would be able to see the same situation happen down here. Directionally wrong, volatility crush made us a winner, okay? Now we'll go on to the next day. This was the next day, early morning on JP Morgan. It was inside that market maker move by $1, but we would have been selling those 87 and a halves, probably the 87 and a halves, and you can see what volatility did. It went further down than what we had expected, but it's still, that's what the volatility crush does in one day. That makes sense for everybody? What is the Theo price? Is it the same as the mark? No. So the theoretical price is generated based on theoretical value of what volatility and stock move and theta decay all at once. So if you had a 1 day's worth of theta decay, if you had a 28% drop in volatility of this underlying and a move of $1, they have some kind of calculation that comes up with it, and I don't have any idea how they come up with that. We used to have sheets that we put it into the computers for to figure out volatility, and we'd pull volatility out and add Theo values that way, but it was run through a computer. We never really did that on paper, so it's, I'm sure, done the same way, and I have long since forgotten how to come up with that computation, that calculus computation. But anyway, so that's the nice thing. You can kind of punch it in there and get a pretty good idea of what's going to happen and see the results the next day. So this is generally where I pull up the option montage, and we can go into it a little bit more detail. We're not going to have, the thing about Mondays is, oh, I wanted to mention one other thing. I want to show you guys the website that I use, Morningstar. So just type in Morningstar earnings calendar, and basically you can see all of the dates. You can flip through them further down the road or whatever. This is the one I use. You can go to like NASDAQ or Yahoo, but I like to use this one. Morningstar is really nice platform, and you can basically sort them too. So you can hit the time before, after the market. Morningstar had their earnings after the market today. So you can kind of figure it out. So for Monday, you know, you'll look at Monday, and they actually do have a lot. Usually Mondays don't have a whole lot before the market for sure, but they do have a few right now. But we'll have a lot after the market. So, you know, there's a lot to play with here. And I usually just run down the tickers and look for the ones that I kind of recognize that I use a lot of, and then jot them down. So you just kind of flip through them. So that's a really nice website to do that with, to figure out your earnings calendar stuff. Yes, that is really nice to simulate, and you know, it gives you a really good idea of where your risk is too. So you can figure out, well, with that one, where is it? With the theoretical value, the really nice thing about it is you can see that the power of volatility contraction. You know, I mean, I could have sold the what is it, the 86 and a halves, and think about it. If I got that $2 move that I'm talking about, or that $1.80 move where it's trading $86.90, these things are 40 cents in the money, and it's worth 45 cents. I didn't lose anything. That's the power of that, as far as I'm concerned. You probably even look and see what it happened to the 86s. 59. That's not quite that accurate, I guess, right there. Because that was, oh, no, sorry, 30, but they're still out of the money. 86 and a half is what we were looking at, right? Wasn't it? Did I say the 86 and a half? Yeah, 45. The 86 is, you know, that's just too deep in the money, but the 86s, look, you still made money because you would have sold them at 86s, you would have sold at 60 cents, and you could be buying them back at 59, and you're $1 in the money now. or not dollar in the money, 30 cents in the money. That's the power of volatility contraction in real life. All right, so I think I pretty much ran over everything on these particular ones. Do you guys have any questions? You guys have been asking a lot of questions, which are great. And did I answer everybody's question? So usually I pull up the option montage and do it, but because it's after the close and stuff like that, it's not going to be really beneficial. We could have looked at some of those on Monday, but I think I pretty much showed you guys everything. Does anybody else have any questions? Theoretical price is not the intrinsic value, right? No, theoretical price is not the intrinsic value. It's just the theoretical price there is based on, you know, the values of volatility, and it's basically going to be Black-Scholes in a sense, and they're just going to adjust all those parameters within the theoretical price. Actually, here, you know what, since you guys have a lot of questions about the theoretical, we'll pull up the option montage and theoretical. So let's just pick one of these that have high implied volatility. This also is something I always do, is throw over here in the gearbox. You pull that up and add implied volatility, and then I always rank them from high to low. So we could see, let's just go with FXE and look at something where, when was Target's earnings? No, it's not far close enough. I'm going to try and find something that has the market maker move up here. And I don't know any of their, all right, I don't know when their earnings are. Well, we can look at this. So we can tell that earnings aren't here, the earnings aren't here. Which one's the biggest one? Well, Macy's earnings must be coming in this May because that has the highest implied volatility. As a matter of fact, and then we'll just cross-reference, check and see when Macy's earnings are. So earnings for Macy's comes in on the 10th. So if we go back here again and look at who expires on the 10th, or I guess this really could have the earnings in there, to be quite honest, because they expire on the May. And that volatility might increase to be a little bit more than here. So what you do is you go up here to the theoretical. So I do the drop down here, theoretical price mark. I got to change it. Let's hit reset. And say, you know, next week, let's just pretend the earnings were on the 30th. Okay, so I can change the earnings were on the 30th, and then you can play around with the stock price increases by, you know, $3, or let's just say $2 to make it more realistic. It's actually probably close. It's probably going to be like $1.50 is my guess. So we'll just make it somewhat realistic. Let's just say that price says it's going to increase, or up or down. We'll do a negative since I showed you the positive already. Down by $1.53. Now our volatility adjustment is going to be a little off because it's so far away yet. But let's just say it goes down by that same, let's say 30%. Goes down, make it a negative 30%, and then you just hit enter, and you see all those adjust over there when I did that. So it goes down by $1.50. We're trading at $29.50, so that's 31. Or sorry, when I'm adding, that puts us at 28. So you know, the 28s, you can see if we had sold the 16 delta, I don't have the 16 delta, but I'm guessing the 16 delta is right around in here, the 26s. So, you know, it'd be only worth a penny. Do I have, yeah, so it'd only be worth about a penny afterwards. So you can play around with it. You can see that if I got a $1.50 move on the downside, and I just sold these 29s, 50 cents away, those are now $1 in the money, and you wouldn't have lost any money. So that's why it's really important when selling options premium that you sell when premium comes out, rather than selling low implied volatility percent, like you sell one of these down here, and this goes for any type of, whenever you're selling with outside of, we'll go outside of earnings for a minute, and say that I sold these puts, say I sold these puts way out here that are like 5 cents or 20 cents or something. Let's just say I sold these puts here, SLBs, terrible example because it's such a small premium. Let's just say J&J. So we sell something out here. Let's say we sell it $10 away, right? What happens if the price doesn't do anything? So I'll hit reset. A few days go by, right? A few days go by, pass along, and we get this to go up, by, let's say, you could say 100% really, if it goes to 30. Let's see what that does. If it goes up by 100%, which makes that 30, right? Look at the difference in the premiums. You would have been, and it didn't move. You got like several days of theta decay happening, and with volatility increasing like that, you got kind of hurt if you sold these 15s. Or you didn't make any money. Does that make sense? That's why it's important to sell high volatility and you buy low volatility. And that's why you would never buy an option right before an earnings. And I've read articles from Goldman Sachs saying the best strategy out there is to buy calls 5 days in front of earnings and then get out of them after the earnings event. It's the worst strategy known to man. But never listen to those guys, because those guys always talk out of both sides of their mouth. I've been in the pit before seeing a guy on TV talk the complete opposite of what his order in the pit was doing. So don't listen to those guys. They're trying to get you to do the wrong thing. Goldman Sachs loves us Muppets. Yes, they do. Okay, if I do not know if the direction of the stock will go up, could I still do this play? If so, how? Yeah, absolutely. If you don't know this stock is going to go up, you can still do this. Just get outside that market maker move. And I showed you, if you're directionally wrong, like if you have a pretty good assumption that, hey, it's going to go up, and that's why, and you're worried about the upside, then, if you're wrong and it comes down, you can be directionally wrong and still make money with this, or at least a scratch. And in my eyes, a scratch is a winner. So anytime you can get out for a scratch when you're wrong, that is a win-win as far as I'm concerned. And next week we're going to be talking about, if you just really have no idea which way it's going to go, but you just don't think it's really going to go anywhere, or you're just pretty market neutral, we're going to be going over these strangles in there. I don't usually do the straddles, but I will talk about them. Not for earnings anyway. So I usually do the strangles. One other thing, let's get rid of this and look at the delta. So let's go back to one that has high implied volatility again, just so that I can show you what we would do if Target was coming out with them. I told you I would be selling like the 16 delta on one of these or something. I can't find the 16 delta, but what is their implied value? 91. So in that, I would be looking at probably selling the 25s here. I would want to get 30% the width of the strikes in this. So see what we'd get. What did I do? Oh, I bought both of them. I want to sell those. And Target has really wide markets right now, it seems like. So why is it? Come on. So buy those. So 41 cents. So I really want to be able to get 60, at least 60 cents, because it's $2.50 wide. I want to probably get close to 75 cents to like 80 cents for this. So that I wouldn't even do this one for that regard. But if we were going to sell strategy, you want to get a third the width of the strikes when you're selling the put spread. That's obviously a call spread. So same thing here. So we would be selling the 2.5s and buying the 50s. That's only 54 cents. So I probably wouldn't be doing that. And if it's $5 wide, you know, basically it's $1.50. So you want to play it that way. That's the rule on selling the put spread. I've covered a lot about the just naked strategy. If you're selling a put spread, then you want to be getting a third the width of the strikes before you sell it. The other thing I talked about for that earnings event, if we were going to sell, these 16 delta puts, I think this is the right one. Yeah, no, that's the wrong one. If we were going to sell these 16 delta puts here, I don't have it go out far enough, but in a sense, let's just say it was something like this. I'm going out and trying to buy something for less than, you know, just for a couple of pennies. And in that, you know, it's a 1 delta, which means 99% of the time it's going to stay within that area. But you're just going to buy it for the least amount you can. You're just basically trying to cover the bases on the rules in an IRA or something like that for a defined risk strategy. Are you more inclined to sell calls or puts if you don't have a directional bias? If I don't have a directional bias, I'm selling both. If I have a bias, then if I'm bullish on it to the upside, I'd much rather sell the puts, because puts have a tendency to have skew to the puts. The reason why is because people have a lot of stock in their portfolios, outright stock, and when they want to hedge that risk, they go in and buy puts more often, especially around binary events. They buy puts to cover themselves to the downside, which pumps up that volume. And I would not suggest doing that, because when you do that, if you are long stock and you're hedging yourself with an option by buying a put, you're actually increasing your cost basis of what you paid for it. You're making yourself pay more for that stock by buying these puts. So I wouldn't do that. Anybody else have any other questions? In terms of selling stock selections for selling premiums, do you have any criteria in selling stocks for selling premiums, like blue chips, etc., or is it always based on high implied volatility? Luke, it's always based on high implied volatility. How do you hedge then, Mark? Great question. I usually, if I'm worried about the downside on an earnings event for a stock that I own in my portfolio, if I own it in my portfolio, I think it's always going to go up, right? So if I was worried about the downside for an event, I'd get out, is the way I look at it. Or if I was worried about it to the downside, I'd probably sell calls against it and do covered calls, because then you're lowering your basis. So if it does go down, you know, then those calls kind of lowered your basis. But I'm always selling calls against stock that I'm long. And people are like, well, what about your upside potential? Well, at the end of the day, markets go up, markets go down. If it comes up and clips me out and I'm selling like a 16 or a 20 delta, only 16% of the time am I ever going to have that stock called away from me. And then I'll just wait for it to come down a little bit. But, you know, I've still participated on the upside. You know, those are rich guy problems when your stock gets called away from you, as far as I'm concerned, because then you obviously did something right. And you always look for a pullback. So that's the way I look at it. If I were thinking I needed to buy puts against my stock, I'd probably rather sell it. or just sell calls against it. That makes sense? Because if you always are buying puts, you know, if I paid $50 for the stock, you know, and I buy puts every single quarter for earnings, you know, I'm paying 30 cents every single quarter, you know, you're ended up paying a lot more for that stock than what you ever thought you did. And it's going to look like, yeah, I made money on this while it went up, but yeah, but you lost a lot of money on buying those puts. All right, well, that's about it. All I got for you guys. In this chat box, I'm kind of running the show here, so hopefully I did that right. If you go into the chat box there, off to the side, we're using the questions box, but in that chat box, there's a link to a special offer, which is a really good one. It's a 1 month for $7 premium membership trial, which gives you everything. It gets you access to all of the videos. It gives you access to the webinars. It gives you access to over 50, I think it's closer to 100 videos now of the archive webinars, and it also gets you access to the live trading workshops, which is what this is considered as this website or this webinar, and the daily market commentaries. And as far as I'm concerned, to get the daily market commentaries for a month for $7, literally you're going to see me trade for a full month. Every trade I get in, every trade I get out of. I talked, like today, I went through all the stocks that were, you know, I was playing around with or was going to have issues with, and talked about that in the daily market commentaries. And you get access to me with the premium membership. You get access to me. So if you have an issue on a stock or a trade that you have or wanted to know my advice on it, I have a no inbox policy, which means if you write to me, I'm going to get back to you right away, because I know how it is when a trade's going against me and you want some answers. I'm going to be there for you. So you get access to that as well for $7. I mean, this earnings season alone, you can't even go to lunch for $7, but should make up for that rather quickly. So that's the link. Also, if some people will be watching this on tape delay that may have had to leave early, you can either write down the URL right here. This is a dead link also, but you can write it down here if you pause the video. And in later webinars, I'm going to be drilling down on options components, how to trade, when and where I find them appropriate. If you guys have one that you want me to cover in a webinar, please reach out to me. We're always looking for things to talk about in daily market commentaries and everything else. You can also contact us at 310-598-6677 or email us at trading@protraderstrategies.com. So go for that. You know, so if you guys like this video, if you guys learned anything at all from just this one video for $7, that is a bargain. You'll learn a lot more from those option strategies. I covered just about every option strategy I ever trade with. So Rick, I see your name. I got to read yours before I read it out loud. With that many videos, you sound like market. What? I can't read that. Star. Bleep star. Thank you for that, Rick. You're always good for a laugh. And good to see you're back. All right, that's all I got for you guys. Have a great weekend. Appreciate you guys, all your participation. It actually makes these webinars go a lot faster for me, and hopefully, you know, when you guys are asking those questions, a lot of times people out there just haven't asked them but may have that same question. And one thing I forgot to mention, when you get this in the email, watch it over again, because if you're not familiar with this and want to really sink in, watch it again, because that'll put it into your long-term memory, and you won't have to really like go back and now, what was he saying? Was it a 16 delta? Or what was the width of the spread? Or what was the credit I'm supposed to collect for the width of the spread? You know, things like that will make that sink in for you, all right? Have a great weekend, guys. That link right there is in the side there. So you can click on it. It's right there off to the side in the chat window, you guys, all right? If you can't take that, take it easy. JQ, got it. Take it easy before I got it out. Thanks, Rick. Thanks, JQ. Take care, everybody. Thanks, Stan. Have a great weekend. Bye-bye.